Welcome to Industry Insights. Thanks for joining us today for Keeping Score, Improving Your Credit and Boosting Your Returns. It is my pleasure to now introduce today's special guest, Steve White. Steve founded American Credit Repair in 2003 with the sole intention of bringing a level of class and personalization to the credit restoration industry. And that was desperately needed. So he has accomplished just that. Steve employs a staff of 30 employees and has managed to exclusively position American Credit as the #1 credit repair provider in the real estate industry. So offering to help clients nationwide looking to qualify for any and all types of real estate financing. During his tenure, Steve has helped repair over 50,000 clients' credit. So being in the realm of real estate, we all know the impact that credit has on qualifying for financing and getting the best rates. But we also know the difference between just having okay credit and having great credit that can have not only on your business, but in your life in general. So we're thrilled to have you, Steve. Welcome.
Yeah, thank you. Nice to be here.
Taking the mic with our special guest today is our very own Bill Tessar. Bill is president and CEO of Civic, and he has over 30 years of mortgage industry experience. And Bill previously founded and served as president of 3 mortgage companies, resulting in residential funding volume of over $35 billion. And he recently took Civic to surpass some pretty exciting milestones, including funding over 12,000 loans, funding over $5 billion in lifetime funding for Civic and real estate investor loans exclusively, and surpassing $1 billion in 2020 alone, which we all know is remarkable in today's industry. He is a Glassdoor top CEO, HousingWire Vanguard recipient, and is a leading voice in the industry today. And he is going to share with you not only his expert industry insights, but also tap into the knowledge of our guest, Steve White. So without further ado, I'd like to kick things off by welcoming our president and CEO, Bill Tessar. Bill, over to you.
Thank you, Liz. Steve, thank you. Everyone joining us. I go back quite a few years with Steve, both personally and professionally, the whole time with American Credit. And I think really the reason he's here today, number one, his company does what they say they're going to do. And when you're protecting a client or directing a client in a certain channel, in this case, credit correction, that matters. Two, I believe they know the credit game better than anybody else in the space. And three, most important, I trust them. So again, Steve, thank you. When I think about credit, I think it drives everything. Today, we're going to talk about how it drives real estate or access to financing, the cost of credit, but it literally impacts everything you want to leverage. There's no item more important to ensuring the lowest available financing than credit. And so with that, I thought we would just jump right in. And there is, Steve, before we get into the nuts and bolts of it, there's a lot of confusion around what credit repair is, or debt settlement, or credit counseling for that matter. And I was hoping maybe to get started, you could provide an oversight of the differentiation between those three.
Yeah, that's great. A lot of people assume credit repair is debt settlement or credit counseling, which is really not. Those are separate industries. And a lot of times when clients have that need, we'll refer them over if that's what they need. But to give you a short and sweet version of what credit repair is in relation to those other two, credit repair is the legal removal of erroneous or unverifiable items off your credit report. So items, derogatory items, even good items, even positively reported items can be removed because clients may have items that don't belong to them. They may be positive accounts, but they want them removed. So credit repair is the removal of items that either don't belong to you, they aren't reported correctly, or derogatory information that hasn't been reported according to the law. Debt settlement is settling debt. So if you have overwhelming debt and you're not able to pay the payments and you've charged off or had a lot of debt build up and you want to settle that debt, that's where a debt settlement firm would come in. So it's a company that will settle your debt, where they're going to negotiate down the amount you owe and settle those balances to zero, for so to speak, is a debt settlement firm. How they work is usually what they'll do with the client. If you have 10,000 is usually the number they look at, 10,000 or more in debt, they're going to come up with a plan for you on how much you can afford, and they're going to take that money per month, put it into a trust account. As that trust account builds up funds, they'll make calls to your creditors for you and negotiate a settlement amount. So a debt settlement program usually takes 2 to 3 years to complete. And at the end of that program, the client's still left with negative items on their credit because a lot of times they have to fall behind in payments in order to get those banks to take settlement offers. So credit repair and debt settlement are really sort of the opposite end of the spectrum, but they both achieve a similar goal. With debt settlement, your goal is to remove the debt. With credit repair, your goal is to remove the negative items off the report. So what we like to do is wait until a client has finished the debt settlement program before we engage them for credit repair, because as you're in the middle of that program, you're going to be missing payments, which is going to cause new negative items to show up until those debts are settled. But a lot of clients don't realize in California, you technically don't owe the debt after 4 years from the date of last activity. And just a side note on that, there's different laws per state for the amount of time that you owe debt. So the Fair Debt Collection Act governs how long you owe that debt for, and it's state by state. And California happens to be one of the more lenient states. So I get clients a lot of the times that come to me assuming they need debt settlement, and it's been 5 6 years since that debt had any activity. And the only thing a creditor can do at that point, so after the 4 year mark, is receive a payment from the client. But clients will come to me all the time that say, I just want to pay it all off. Which ones do I pay? How much? And a lot of times they're surprised to find out technically after 4 years, you don't have to pay those. The creditor can receive a payment from you, but credit repair might be a better option to go, because if we can remove the mark off the credit report, the only way that account can be put back on the report is if there's activity to report. So when clients come in and pay an account that may have been deleted through credit repair, the creditor could essentially put that back on. So we always like to look at the client's credit first and then point them in the right direction. Debt settlement or credit repair usually are the top one and two ways to repair a client's credit. Credit counseling is, I don't know if you've heard of it, but it's more of those government agencies where they're .org, and what they do is they'll step in and assume control of the client's credit. They'll leave negative marks on each account they're helping the client with. And what they do at that point, it'll say account being managed by credit counseling service. I don't know if you've seen that on the report, but what that is, that's when the client just basically has lost control of bills. They're unable to pay them, and they're not quite at the point where they've gone off the cliff, but they want help in saving themselves from losing that credit rating. So what they'll do is they'll engage a credit counseling center where they call and negotiate lower interest rates with your creditors. Sometimes they'll get the creditor to hold payments for a couple months to allow you to catch up on bills. So they're sort of a last chance to save your credit before it goes off the cliff. Credit counseling usually damages the client's credit to the same tune of a bankruptcy. So if a client has a bankruptcy or credit counseling on their credit, even though credit counseling it's not a negative mark, it's that notation that they put on the accounts that damages the score.
Steve, you started answering the question by talking about the legal removal of credit items. And I believe what the FCRA, or the Fair Credit Reporting Act, is that act which you do this illegally. Could you tell us just a little bit about that, why that's important? And then we'll talk a little bit about how the credit repair works.
Perfect. Yeah. The Fair Credit Reporting Act, for those of you that have not heard of this law, it was passed back in 1970. And they passed this law for two reasons. One, to make it harder for creditors to report information about us to the credit bureaus. And the other reason they passed that law is they wanted to give us a chance to have a remedy or a recourse method to remove items off our credit that we see are mistakes. So how to correct mistakes. They did that because back early in 1970, if you can just imagine back then, it was a totally different world than it is today. I mean, faxes were pretty much just coming out in the business world, and everything that was being reported to the TRW and Experian hadn't even been formed. was being reported by mail or by fax. And a lot of mistakes were appearing on people's credit, and they didn't really understand how to fix those mistakes. So they came up with this law that created a series of guidelines and bylaws that the creditors have to follow in order to report information. And it also, in that law, they wrote a loophole that allows the client to ask the creditor to verify and prove the accounts are accurate. And if the creditor doesn't verify that account in a certain amount of time, which used to be 30 days, now it's 45, the credit bureaus have to remove that account off the report. Fast forward time into the 80s, it took some clever attorneys to figure out that loophole that I mentioned was written into that law, which is that 30-day timer. So a lot of companies that'll tell you they have a special magic wand or a way of removing negative items, they're really just not telling you the truth. The truth is that 30-day timer, which is now 45 due to COVID, is the magic wand to credit repair. So creditors have only 30 to 45 days to verify an account belongs to the client and has been reported in accordance with that law.
And so, Steve, let me just jump on that for a second, because I think this is where people might get lost. So that gives you the vehicle to use. But when you say reporting correctly, someone may have a 30-day late, but they report the wrong balance, the wrong start date, the wrong high credit limit. It's the complete and accurate reporting of the entire account. And without that, they would have to delete that. Is that correct?
That's right. Yep. So what happens, there's two ways to repair your credit. I'm sure we'll get into that in a little bit. The traditional way a lot of people are familiar with is the dispute approach. So you've heard of dispute letters. What that approach is you're writing the bureaus a letter saying, hey, I don't think this late payment is mine. I don't remember missing the payment, or it says I missed the payment in May. I think it was a different month. What happens when you go to the bureaus is that law kicks in, and in that law, the credit bureaus also have to go to that creditor, and that's where the 30-day timer starts. The credit bureaus will go to the creditor from the client. So the client initiates the bureaus go to the creditor. And what the credit bureaus are asking that creditor to do is respond back with those two items I mentioned for proof. So they have to prove that the law was followed, meaning did they report the information correctly? And the other thing is that client, did that client really miss the payment? So they have to verify the client was late, and they have to verify they reported it correctly. If the credit bureaus don't receive those two verifications within that certain amount of time, then the item has to be deleted by default by the credit bureaus.
Is it deleted permanently? Can they correct that, or how does that work?
That's a good question. Actually, with the dispute letter approach I mentioned, it really rarely is permanent. And a lot of lenders and realtors out there that used to send us clients way back when I first started the company, we were disputing stuff for the first 2 years. That's honestly what we were doing. And I didn't realize this new approach was out there, the approach we use now. And so what happens is clients will enroll with a credit repair firm. Lexington Law would be a good example of a dispute letter writing firm. They'll send letters to the credit bureaus. The credit bureaus will go to the creditor, and then creditors may be delayed in responding. So the item gets deleted by default. But let's say Macy's, for example, didn't get a chance to respond back to the credit bureaus for 60 or 90 days. Well, the bureaus remove the account by default at the 30 to 45 day mark. But when Macy's verifies that account, even at a later date, once the credit bureau receives that verification, and even if they've removed the account, what they'll do is they'll re-report that account back on the client's report. So things that are deleted through a dispute letter approach, I wouldn't go so far as to say they're permanent, even though they could be. So it depends on the type of account, whether or not it was just a delay in the creditor in verification, or was it an actual item that was erroneous or not verified as accurate.
So, Steve, so under FCRA, there are violations, right, for credit reporting companies and creditors. Talk a little bit about that and why that motivates them to either respond or not respond.
That's great. So that brings me to our approach. So the approach we use here at American Credit is the same approach as a consumer law attorney. What we do different than a dispute letter writing company is we actually go to the creditor first from the borrower. So we take the 84-page law, the Fair Credit Reporting Act, from the borrower, and we'll send a letter to the creditor directly with a copy of that law attached. And what we're telling the creditor is, hey, I'm a savvy client. I know what my rights are. Here's a copy of the law for proof. It says here you reported me late on my Macy's card in 2015 in May. I don't think I was. Here's the law. It says here you have to prove it. If you made a mistake in how you reported this, I can sue you for $2,500 to $5,000 as damages. And when you go to the creditor with that sort of a stern approach, what you're showing the creditor is that the client is showing the creditor that they're savvy and they know what their rights are, and they're going to pursue legal action if the creditor made a mistake. We do that first because we want to set that client apart from 95% of the clients that are finding help through a dispute approach or maybe trying that approach on their own. What we do next is we'll go to the credit bureaus and ask them to verify that account. And if we time it in such a way that we're attacking the creditor at the same time involving the credit bureaus and starting that 30-day timer, creditors, by the time they receive that request from the bureaus for verification, have already received that threat of legal action from the client. So they're less likely to respond back with verification when they see the client as a legal threat. So hopefully that makes sense. And the violation you asked about, it's called an FCRA violation, and you can look it up. Usually creditors will pay somewhere between $2,500 and $5,000 per mistake they make. And a mistake can be as simple as reporting you late on the wrong month. So if Macy said you were late in May and you were technically late in June, that's a mistake that can trigger that fine. They have to pay the wrong name of an original creditor. You might have owed Sears and you ended up owing Mervyn's. The amount being off, let's say you owed $1,100 and they put down you owe $2,100, or even less. Let's say they reported you owe $200. If there's a mistake in the reporting, that triggers an FCRA violation, which the creditors know they're on the hook for, but a lot of clients don't know about this. And so when we add this layer to our threat, which is the copy of that law, we're mentioning those specific amounts that the creditor is liable for. And that shows the creditor, the borrower, is more savvy. And what that does is it'll cause that creditor to be less likely to respond back in the correct amount of time. And then the item gets deleted by default.
Yeah, I mean, what I love about that act and companies like yours is it does kind of equal the playing field, because nobody on this call by themselves are as big or as bad or as financially strong as some of these big entities. And I think having that law, the understanding, and then a firm that applies it, I think makes all the difference in the world. And I know that's what you do. Let's jump into top tips. So everyone grab your pen and piece of paper if you're not driving, and top tips that you could share with this group about improving their score. Maybe top 4 or 5.
Yeah, if I were just coming at this without any knowledge or experience in credit repair like I have, the top tips I give my family and friends: pay your bills on time. And on that note, it's one thing to pay your bill before the 30-day mark, meaning pay your bill within that 30-day period, you won't have a late payment. But if you pay your bill the day it's due, or even sooner, meaning as soon as you make a charge, pay it, there's a reporting that happens from that creditor to the bureaus that's also ranking you. So it may not be a derogatory hit to your credit because you were late and over 30 days late. But if you're a habitually late payer, let's say you're paying your bill that's due on the 1st, on the 29th of every month. So you're getting a late fee at the 15th. You're paying it at 29 days after the payment was due, but it's not 30 days late. That's going to be reported to the credit bureaus also. So a lot of people don't know that, but there's sort of a sub layer of reporting that happens from the creditor. And that ranking that they're reporting to you affects your score. So you won't see it on as a derogatory item so much that's hitting your score, but your score could be trending downward as you keep paying those bills late. So that's an important note. Don't ignore any calls that come in that may be a collector calling, because a lot of clients that come to us will enroll with us and then assume that they just can go back to their old bad habits. And we try to guide those clients to make sure you don't ignore those calls, because a lot of times if a collector's calling you, you may be ignoring that call, and then a negative item could appear where you could have caught them in the middle of that process before it was reported and resolve that item. So if you had for example, a $50 copay at a hospital and you didn't answer the phone and didn't respond, and maybe they had a wrong address, now all of a sudden a $50 collection item ends up on your credit. It's a lot harder to get it removed even by paying those once they're on your report versus handling on the phone call that may have came in that you just didn't realize was a collector. Paying down your revolving credit cards, all of your revolving cards, to 30% of their respective limit or less is really good advice. So Macy's card, let's say you have $1,000 limit, get your balance to 300 or less, and then start to train yourself to see your max as that 30% mark. So if you're going to use your Macy's card, try to not spend more than that 30%. If you do know you went over it, let's say you bought something that was at 50% of your limit, the next day you should make a payment to at least get that balance back to the 30% mark. Don't wait for the bill is what I mean. Just pay the difference. So if you know where your balances are at in relation to your limit, just make a conscious effort if you can to pay those to 30% right away, and then try to think of them as maxed out at that point. Here's a good tip I give all my friends and family. It's a free one. You can recommend this to your clients as well. I don't know if you've heard of it, Bill, but there's a website called optoutprescreen.com. And what that is it's a website that was created to sort of give us a fighting chance against the creditors. And creditors lobbied Congress years ago for access to our credit report without our knowledge. And what I mean by that is their creditors are looking at your credit report and mine through what's called a soft inquiry. So I'm sure you've probably heard of soft credit pull. There's a difference between a soft credit pull and a soft inquiry. A hard inquiry is where you or your borrower will sign a form giving you permission to pull their credit, typically a FICO type report. That's a hard inquiry. A soft inquiry is where a creditor is looking at your credit without you knowing about it. It doesn't ding your score. You don't have to sign a form to do it. And every 2 to 3 months, creditors will go into your credit report and look at everything on there, and they can use that information to lower your limits or to raise your rates or to deny you that credit line increase, even though you may be paying that creditor on time. So if you have a Chase card or a Wells Fargo card and you're paying the bill on time every month, your balance is nice and low, well, Wells Fargo or Chase should only have access to your account with them. But through that soft inquiry I mentioned, they're able to see if somebody sues you or if you maybe missed a payment on your car loan or you had a collection show up. And they can use that other information to affect your account with them, even though you may have a perfect standing account. And you may not realize this, but when you gave them this permission, do you remember when you get your credit card in the mail, a new card, and there's a little sticker you call to activate the card? When you're activating the card, you're also agreeing to the terms and conditions of that bank. And in that little booklet they send you on Bible paper, in there it tells you that you're giving them permission to look at your credit through the soft inquiry portal I mentioned. And so opt-out pre-screen is a free way to sort of close that door to all creditors. So if you go to opt-out pre-screen and just register for 5 years, takes like 5 minutes, you close off that level of access they have.
Hey, Steve, on that though, if you accepted the card under the agreement that you would allow for soft inquiries, and then you go in and opt out, does that create a trigger where they could say you're in violation of your card and then cancel your card? Nothing
Not at
like
all.
that.
Nope. The opt-out feature is basically, think of it like a door that you just close or a security patch you put on your router. So once it's in closed, it's basically closed to all future creditors. The access that I don't want to say that when you activate the card, you're automatically opening the door. That's not how it works. The door is shut when you shut it, and it stays shut until you decide to open it again.
Got it.
Well, 5 years is what you can do temporarily. That's what a lot of people will do. It takes a few minutes. I personally permanently opted out, which requires you to print out a form, submit proof of ID, mail it in, and then you permanently end up opted out. So that's shutting the door permanently.
Yeah, the one thing I'd add before I go on to the next question for you is I think you mentioned it a little bit about insurance premiums and insurance bills. For everyone on the call, what I would do is I'd have a separate folder, something like I carry these folders. Well, I don't carry them, but I have them at the office, just a separate blue folder like this. And I would have anything to do with any insurance related billing. When that comes to you, you have the bill, you document the conversation, who you talk to, when you talk to them, and you resolve the matter either through the reissuance of your insurance or the payment of that. There's no one single sneak up bad mark from all of my constituents that I've worked with and have over the past 3 decades that could grab your credit like an insurance bill. It's you pay it, they'll send you a demand, they go to collection, and now you're dealing with a whole different problem. And so, yeah, I think keeping that documentation in one folder so you could use as future reference will also help you when you're dealing with Steve White and his company and you're disputing a particular claim. Hey, so obviously the difference between good credit and bad credit is impacted in the interest rates you pay, whether it's credit cards, autos, real estate, lines of credit. What other things would you say are consequences of bad credit or not excellent credit?
Well, not qualifying for a property, losing out on an investment property. That's one consequence of bad credit that I'm familiar with a lot. Jobs nowadays, employment, they're looking at your credit now. So for government workers like fire department, police, nurses, credit reports are actually part of the interviewing and hiring process. And clients are being made aware of that. So I have clients that'll come to me. I had a kid that was 24 years old, academy, ready to go become a firefighter, and he was at his interview. He was at the very last interview, and he was sitting in front of the fire captain, and he had his credit report, and that was the last stage. And he had I think he had a repo from when he was like 18 or 19, something that his parents had co-signed for that he just fell behind on and lost. And it was the deal breaker for his job. So he came to us just practically in tears because he spent years in the academy, ex-military. He was going in just fired up and ready to be a firefighter. And then his credit report was the deal breaker for him. And it was something when he was 18. I mean, it was understandable that they have this criteria, but at the same time, that's just an example of how it affects your job hunting as well. A lot of people don't think of it like that.
Yeah, I think the insurance thing kind of caught me off guard. Like, I really thought it was more of a physical thing, not a financial thing that they based the premiums on. And when you think about like conventional financing and even private money, I look at our rate sheets and they're all tiered. And so someone below a 600 is in a certain credit box, credit interest rate, credit fees. Then maybe that next break is 620, then the next break is 680, and then like 720 and above. So the points actually matter, and you're starting to collect this thought process, all of you, in that, yeah, we got to pay on time, keep our balances below 30%, have some access to credit, right? All these things actually matter, and it's materially different in terms of what is going to go out of your pocket every month based on that. Probably nothing more important. So look, we talked about the bad credit. What about maintaining and protecting good credit? Other than paying your bills, a couple other tips or tricks that you've had in the past?
Yeah, that's a great question. There's two types of security you can put on your credit report that protect your good credit rating. One of them is called a fraud alert. This one's a little easier to do. You can either call the credit bureaus yourself and put a fraud alert on the account with a simple phone call, or mail in a letter just requesting them to put a fraud alert on your credit. What a fraud alert does is it puts a 90-day protection on your credit report or your personal score. And it sends a message to any creditor that's pulling your credit to double check your identity. So some creditors are pretty relaxed in pulling credit. Clients will call you over the phone and say, hey, I want to pull my credit, see if I qualify. Well, with a fraud alert on there, it requires that person pulling the credit to actually see your ID, to physically verify your identity. So that might be that's one layer of protection I recommend. There's a more aggressive level of protection you can put when your credit's really good or you think you've been compromised. You can put what's called a security freeze on your credit report or your credit score. And what you'll have to do in that instance is the same thing called the bureaus. You have to verify your identity with the bureaus. And then you'll create a passcode with each bureau that only you and the bureaus have. So think of it like a safe word at your home when you have a home security system. If they call you, what's the safe word? Same thing with the credit bureaus. When you put this security freeze on your credit, it locks your credit report. So no one, including you, could pull your credit. So you could lock your credit and then go to a car lot that same day and they wouldn't be able to pull your credit at all. It'll just tell them it's locked. I'm sure you guys have seen that if you're pulling credit for clients. And a security freeze is a little more involved in setting it up. You have to pay a $10 fee at each bureau. You have to create that passcode. There's a little more verification process involved. And then to unlock it, you have to pay that fee to unlock it. So they charge you to lock it, charge you to unlock it, and then you have to relock it after you've used your credit for whatever you were looking to buy. So if you're buying a house or buying a car, you would unlock it, use the credit for that transaction, then relock it when you're finished. It's sort of a more aggressive approach. So in addition to all the tips I gave you on keeping the score nice and high, those are two tips I would give you on just making sure you protect your good credit.
So when we were talking last week, Steve, we were talking about like some of the crazy stories, and I had asked you like, what are you most proud of? You told me a couple of items that I was like, that's incredible. I'd like you to share it with others. So
Yeah,
success stories or the things that American Credit's most proud of? What would that be?
I would say, I mean, we have three successes I like to brag about, and we've been in business 18 years. So I've been hoping to see someone beat these, and so far they've held for a few years. The most number of negative items we've deleted for one client was 152 negative items, and she started with 176 negative items on her credit. It took us a year and a half, so she enrolled three times. But by the end of her third enrollment, we had sent out a summary of what her credit looked like when she started and what it looked like now. And she went from 14 pages down to 4 pages of credit. So her credit report was just a mess. And I like to tell this story because, believe it or not, she wasn't happy. I called her up after that email went out, and it was just a sea of green. Like, we like to itemize every item we delete in green, and anything red is something new that came up, or maybe some advice wasn't followed. And it was just like pages and pages of green negative items that were removed. And I called her up and I was like, Maggie, did you see that email? Did you see what we did for you? She was like, yeah, I saw it. I'm not very happy. I'm like, why not? She goes, you didn't get my AT&T bill off. It was like a $57 AT&T bill that it must have been a thorn in her side, somebody that really harassed her on the phone that got under her skin, because that was the only account that mattered to her. We could have wiped every one of them off, but that one. And so it was kind of funny. And so that's our most number of negative items, 152 out of 176. The highest increase we've ever raised a client's score, we've done it twice, is 287 points start to finish. So one of the bureaus jumped from the 400 range up into the 700s. And that was the first time we set that record, was like 12 years ago. And we had a client about two to 3 years ago that had a 223 point increase at the midpoint review. We do a halfway review for everybody. So at the halfway point, this guy had already jumped 223 points. So I thought he was going to be our new record holder. So I set myself a task to check in on him after the end of the program. And his final jump was 287. So 2 to 3 years ago, this guy tied our record holder from 12, 14 years ago. So 287 is the most we've taken the client's score from start to finish on a FICO report. And then the highest score we've ever achieved for a client on a FICO report is 837. So they started at 719, and when we were finished, they were 837.
And what's the highest the score goes to?
The highest on a FICO score is 850, and on a Vantage scoring model, which is like your Credit Karma type score, is 990. So an 850 is a 990 on a Vantage report.
And is that for all three credit repositories?
All three, I think it's 980, 990. I'm pretty sure one of them, an Advantage, is 980. And then I think one of the three, I'm not 100% sure, I'll look into it, is 840. So I think two of them are 850 and one's 840, but I'll get the answer on that.
And that, we didn't talk about that, but it just kind of triggered something. I'm sure most of you on the call know, some may not, that your credit score is really evaluated with three separate and distinct agencies, which is TransUnion, Equifax, and Experian. You heard Steve White talk about when back in the olden days, he was pointing at me, they had a TRW, and that was actually the credit agency that governed all of our credit. And it was actually the lower the score was the better back in the olden days. And that has now changed to three agencies. So when you think about credit, Steve, correct me if I'm wrong, you're really thinking about keeping your numbers up on all three repositories, correct?
That's right. Yep. There's actually like 18 or 19 different agencies, but the three most recognized are TransUnion, Experian, and Equifax. And a lot of people don't realize these are for-profit corporations. They're not government agencies, and they're separate from each other. So stuff that gets reported to one doesn't always get reported to all three. And that's why clients will ask me, why are my scores so range so much? Like one of them could be 650 while the other one could be 750. And a lot of clients don't realize something may be reported adversely to the one that's lower, but only be reported to that one bureau. So to fix that client's report, we would only need to remove that one account from that one bureau, and then it'll rise up to the level of the other scores. A lot of times clients' balances can be reported to one or two bureaus, but not all three. That happens usually when a creditor is only reporting to one or two of the three bureaus, not all three of them. Collections will show up on one, not all three. So it's a range of different reasons why the scores will vary. Plus, they're not communicating with each other. So,
Steve, we hadn't talked about this before, but listening to you reminded me of a client I sent you a number of years ago. And this will be interesting for all of you. But the client had a bankruptcy, and the bankruptcy was discharged. And what happened after the discharge is all of the creditors that was discharged in the bankruptcy then started reporting charged off debt, charged off debt, charged off debt. So not only did the borrower have a bankruptcy on their credit report, they had like 17 charge-offs, which technically was inside the bankruptcy. So maybe talk about how you guys attack that, because that monumentally changed that person's score as they came out of their Chapter 7.
Well, any item has to be reported according to that law. So when a client has a bankruptcy, what's supposed to happen is the balances are supposed to be zeroed out because the bankruptcy was discharged, meaning it was approved and signed off by the judge, which if it's a 7 means they don't owe. If it's a 13, technically the client still owes it, but how a 13 works is the client will come to the courthouse, the creditors are invited to show up. Whichever creditors show up are usually the only ones that end up getting paid. And how the judge works in the 13, how much you owe, they find out, how much your proof of income shows. They look at how much you can afford. Usually they'll take 1/4 of that, 1/3 or 1/4 of that, and make that the amount that you pay the courthouse. So on a Chapter 13, it's a 3-year payment process. So you're paying the court, a trustee of the court, every month for 3 years. At the end of 3 years, what they do is they take the amount that was received, disperse it equally to the creditors that showed up. Whatever they get, and the rest they have to lose on. So if you owed 50,000 on one creditor and 5,000 on another, they're going to get an equal amount at the end of that 3-year period. And then the one that had 50 may only get 2 or 3,000 of it, and the rest they have to lose. So that's a 13. Removing, and how those accounts, like you mentioned, all those accounts that were supposed to be included ended up showing as charged off. On a 7, those accounts that were all charged off should have had their balances zeroed out, and it should have been noted as included in bankruptcy, which is a notation put on those accounts. It's still a negative notation, even if it said charge off. The only thing that really changes in a bankruptcy is the balance should be noted as 0, and that notation of being included in the bankruptcy gets added. So it'll still say charged off, included in bankruptcy, 0 balance. What we do at that point is we go in and ask the creditor to verify that reporting was done correctly. If it wasn't, then it has to be deleted. Same as the bankruptcy itself. The courthouse has
Same rules, right? Same rules apply. Same rules
Yep.
apply to tax liens.
Same rules apply to tax liens. The only difference in liens, bankruptcies versus normal credit is the amount of time they stay on the report. So bankruptcies and some liens will stay on your credit for 10 years, where normal credit stays on your credit for 7 years. So a lot of you have heard the 7-year rule. It's 7 years from the date of last activity. So you could have an account that you defaulted on in June of 2016, and then they were trying to chase a payment from you for 3, 4, 5 months. You might have made a partial payment in the middle of that. All that negative history, every time you have new activity, meaning if you give them a payment or they sell it to someone else, that starts the 7-year clock all over again. So a lot of clients may go back and forth with a creditor for a year or two, not pay it, then they sell it. The new agency gets 4 years from the date they buy it.
So, hey, Liz, looking at time, I thought what we would do before we go through a giveaway, and all of you know that Steve was super generous, and he's going to be drawing the $1,500 credit correction to somebody here on this call. And looking at that, I think I'm going to match him, and I'll pay for one as well. So I'll pay for one, and he's going to give one. So we'll give 2 giveaways. But before we do that, why don't we go to some Q&A, Liz?
Yes.
Just answer some, because I'm sure we have a few.
We have a dozen questions, so
Yep.
we'll try to get through as many of these as we can. While we were on the topic that you were just covering regarding bankruptcy, I thought this was a good one. What about courthouse debt collection? How long does that stay on? Is it 15 years? Someone thought it might be.
Debt collection. Are they talking about credit counseling maybe?
No, I think
Child
courthouse,
support?
somebody has a lien or some kind of.
It sounds like a collection of any sort is only 7 years.
Okay.
And that's federal law. So the only that are exempt from that 7 years are bankruptcies and tax liens. Everything else is 7 years. On bankruptcies, they do start the timer a little differently. So everything else is started basically at the date of the default item. So once it appears, that's when the 7-year clock starts. With a bankruptcy, it's 10 years from the date you file, not from the date of discharge. So technically the date of last activity on a bankruptcy is the discharge date, which is 90 days later. When you file is when they start the 10-year clock for a bankruptcy. All others are from the date of last activity, except that bankruptcy.
Great. Thanks for clarifying.
Yeah.
So here's a question you probably get all the time. How much does credit repair cost? Because I see ads for companies who claim they can remove inquiries and derogs for
Mhm.
$200, some even less. Is that really doable or is it a scam?
I would say that a lot of those companies you hear those low rates or teaser rates, I like to call them, they may be charging you per item they delete, which ends up costing you a lot more. For example, we have clients with an average of 18 to 20 negative items on their credit. We'll see companies charging $150 to $200 for each item they remove. And there'll also be sort of fine print that says per bureau. So if we were to remove a late payment off your Macy's card and we charged you per item per bureau, even if we charged you $100, we would be making 600 off just that one item, because 300 to remove that item off of each bureau. Well, it's 300 per item we remove. So if we were charging 100 per item, it would be 300 per account we removed. So be wary of whether their fee is a teaser fee or not, because there's some fine print usually associated with all of them. Ask them if there's a setup fee. The most important question I would give, all your viewers to ask any company you're considering signing up with is what approach they use, because there's only a handful of companies that use the consumer law attorney approach that we use, and the consumer law attorneys that do this work we do charge anywhere from 5 to 10,000 per client, and they use that as a retainer fee. So what they'll do is they'll put the money in a retainer, and as any attorney, they'll use that money up for every time you call in and check your status, anytime they mail any documentation out on your behalf, anytime they're updating sort of the back end portal, which is what we use to give our clients an update. They have a back end portal they log on to. Anytime they're doing any work on behalf of the borrower, attorneys that use the same approach we use are just eating that money up out of the retainer. And at the end of that retainer, they're going to ask for more money. They don't offer a guarantee, which is what we do. So we do a initial enrollment analysis, or we do the analysis of the credit. We estimate what the fee will be. We go over it with the borrower. If they enroll, we do a midpoint review at the halfway mark. So we compare a new report with their original one, list everything we've done for them. It gives us a chance to re-guide them if they're off track. And then at the end of the 6-month program, we do a final analysis and we look at the original report and the ending report. And if we didn't accomplish anything, we give the client 100% of their money back. If we do delete something or correct it, we keep $150 for every item we successfully fix. And then if there's a remainder due back to the borrower, we'll give them that back. So clients sometimes get a refund. I would say we enroll 250 clients a month and probably refund 5 to 10. And the ones that are getting refunds are usually getting partial refunds because we get some of the items off, but not enough. And so they earned a refund back at the end. Most of those clients will just elect to re-enroll and roll the
Steve,
balance.
what is the average of the 250? What are they going to pay to have their credit
I would
clean?
say for us, an enrollment fee average is probably around 1,100, 1,200. So we always base our fee on how much work's involved. We do the pre-screen for free. It's a free credit analysis. It takes about 2 hours. They'll get a live call with one of our credit experts and they'll go over the report with them, all free, no obligation to enroll. And we look at a few different factors in determining the fee. How many negative items do they have? What type of negative items are they? Are they a lot of public records, more difficult to remove, bankruptcies? And then where are they at with regard to paying their bills? Are they behind? Are they habitually behind? Are they recently behind? We won't enroll a client that we can't help and may need a different set of advice or a different set of help. We'll point them in the right direction if they need debt settlement first because they're just not able, the stuff is too recent. If they're needing credit counseling, but they haven't gone off the cliff yet, we'll recommend them there. If a client, for example, has had a few things in their past 90, 120 days ago or before that, and they're caught up financially, they're back on track, those are clients we can help.
Okay. Here's another question. I've been getting hard hits on my credit report that I've not requested. How do I get them off my report? And how can I
Hard
tell when I'm
inquiry.
being checked out? Hard hits,
That's
like
it.
hard.
Yeah, hard inquiries. Typically a hard inquiry won't show up on your credit unless you're aware of it, because a hard inquiry is either made, maybe you're calling a company to set up phone service or getting a cell phone. A lot of people don't realize those are also hard inquiries. When you're setting up power at your house, those will be a hard inquiry. But most clients are usually aware of things like buying a car, you sign for that. Going to a mortgage office, you're signing the 1003. So those are hard inquiries that people are aware of. But people, when they see a hard inquiry on their credit, If it's truly something that you weren't aware of, then you have recourse, which, like I said, a dispute letter approach on inquiries for yourself. I would personally go that route. If you're looking at removing something more damaging to your credit, like a negative item, collection, late payment, public record charge off, I would involve a more professional firm rather than try to send out dispute letters. Think of it like you're a doctor and you need heart surgery. You only get one credit score and one social security number in life. If you're going to trust that with a firm that may just be sending in letters you could send on your own, the results may end up being permanently stuck, because you can only go after these accounts through a dispute letter approach 2, 3, maybe 4 times max, and then the credit bureaus will no longer allow you or a professional to come in and do any work for you
Yeah, where
after
they say like already disputed, verified as correct.
already
That
verified.
kind of
Yep.
puts you on the bench for a bit.
Stuck. Yeah. So I always tell clients, think of it like painting your house and or rebuilding the motor of your car. You could do it, but are you going to do it as good as a place that does 200 a month? Probably not. And just trust them. It's not a very big fee, and just pay the money and make sure the place has a guarantee if you do enroll with anybody, because that's important. And make sure they spell out what that guarantee is so you understand how you're protected.
Love the guarantee.
Yeah.
This is a question on how to increase credit. So are there any trades that are better than the other, like
The number
revolving
one, I
charge
mean,
cards, Visa, American Express, loans?
oh, this is some good. That's a great question. I have had clients in the past come to me that they're just rearing to go, ready to pay everything off. And I had a client that had a $500 Macy's card with a $490 balance, and he had a $32,000 truck he had just bought like 3 months before. He was like, "I'm ready to pay my truck off, pay everything off." And I looked at his credit and I was like, "Well, don't pay a dime more to the truck. Just make sure you're paying that payment on time, but pay $490 to your Macy's card, and you'll probably see a 50 to 60 point increase in your score just from that $490." And he was shocked because he's like, "Well, why? I have all this debt. I owe this on the house, I owe this on the truck." And revolving debt versus installment loan debt is a huge difference in how it's reported. So you can have a larger impact on your credit score by just paying down some department store cards you may not be aware of that are over the 30% limit, versus paying an old collection that will reactivate that date of last activity and cause your score to drop. So that's another thing that I wanted to mention is clients that don't understand how credit works, when they get a little money, they may want to pay off stuff on their credit, and paying an old collection account can actually lower your score. So let's say you had a $2,300 charged off credit card from 5 years ago. Well, in the last 5 years, your score has creeped up and up and up because that's the negative item you had. And you've had all these good negative, positive accounts since then. So your scores jumped a little as a result, maybe 60, 80 points since then. If you pay that old account off, legally, that creditor can report the receipt of that payment. They'll zero out the balance. But what happens is the date of last activity goes from 5, 6 years ago to today. And so it looks like a recent collection account because it still shows collection. It'll just show paid and a zero balance. But that date of last activity triggering a recent date is what causes your score to drop.
All the
It'll go
reasons
back
why
up.
you don't really want to do it yourself. I mean, there's a lot of places that you can save money. When it comes to your credit, I actually don't believe that's one of them.
Yeah.
Okay.
Yeah, we've done a good job of keeping the fee down and making it affordable. I have a great team here of reps that, I mean, I've seen them do payment plans as low as $99 because their lender that sends us clients sends us 5 a month, and they're seeing a conversion at their end. Where realistically, for every 5 clients a lender sends us, we'll convert 1, maybe 2 into a closed and funded transaction. As long as the clients will follow our recommendations, 95% of the time they'll hit the scores we project.
Well, this goes right to that topic. If somebody is working with a lender, how long would it typically take to
Good question.
do minor or major? I know it ranges, but can you give a
Yeah.
sense of the timing?
It depends on, the number of items, so how many items they have, whether or not the items are reported correctly, because some creditors will verify and verify and verify. And so we for every negative item on the client's report, we go after each account 4 separate times. So we go after it once, threaten the creditor, we go to the bureaus, ask them to look into it. Then the bureaus ask the creditor to verify it, they respond, and then the bureaus will update the client. So that whole process takes about 45 to 50 days. We look at the report out, the results of that investigation cycle. And let's say they started with 10 items, we got 2 off. We go after the remaining 8 a second time. And we're not threatening the creditor each time. We only do that once. but we're demanding the credit bureau reinvestigate that account a second, a third, a fourth time. So we go after each item 4 separate times. And sometimes it takes 4 rounds of investigations to finally catch the creditor asleep at the wheel where they don't respond in the correct amount of time. And each one of those investigation cycles, they have to respond back to with proof within that specific amount of time. And so a client can see a 60 to 80 point increase in as quick as 55, 60 days. It can also take a full 6 months. It just depends on how hard those items are to remove, how many times it takes us to get the item to remove. And at the end of the program, I would say a realistic success rate you can expect is about 50 to 60% of the items we go after will end up removed. So we're rarely wiping clients' credit clean. We average a 70 to 100 point increase in their credit score. So an average increase is between 70 and 100 points. And an average time frame between 90 and 120 days is a good expectation. And like I said, at the end of the program, if a client had 10 items, we should have gotten 5 or 6 of those 10 off and bumped their score up enough.
Hey, Liz, before you go to the next question, I do think you brought up a point, Steve, and it's important for all of us to note that these companies who are handling these disputes actually have businesses that they are out in the marketplace trying to produce revenue in whatever their products or services are. The idea of reallocating those people and technology to respond to dispute letters inside of the FCRA's time limit. Some have put some resources there, but there gets a point where there's a diminishing return where they could care less about bills 30-day late from 1995, and they got to focus on their revenue producing customer who's in front of them. And I think that's what Steve's company has done an excellent job of, is understanding the law and how it impacts companies, all of our companies. And I mean, if anybody here owns a company, just think about what you would do if you had 50 to 60 inbound messages with a legal document coming to you throughout the month, and you had to respond accurately and in a timely fashion. It's just, it could be overwhelming at times. And that's where the law becomes your friend, right? And serves you, the consumer, a little bit better.
Yep.
I have to say the questions are literally pouring in, so we won't be able to get to them all by the end of the program, but I will pass them on to Steve.
Perfect.
And we will also
just have everybody email me.
Email address so that you can submit some of your individual scenarios to Steve directly. But I can get through a few more of the general ones, because this actually happened to me as well. Is there a different algorithm for a mortgage credit pull? And maybe this is, I don't know if this is a Bill question or a Steve question, but yeah, then, look at your FICO score, and then there's a mortgage algorithm.
Well, that's a great question. Your credit score is a direct reflection of what's on your credit report at the time it's being run. So for example, you went to a mortgage office today, had your credit pulled. They're going to look at it through a FICO lens, which is more geared towards mortgages. And you'll get 3 sets of scores that same day. If you go to a car lot and an auto dealer, let's say Honda or one of the Mercedes dealers, they'll pull your credit, and they're looking at it through an auto score filter. So think of them like filters. Your credit history is what your credit history is. That's not going to change. So every place you go is going to look at that same history, but each source or each place you pull your credit at is sort of applying their filter, or like your guest had said, their algorithm to your history, and then it spits out your score. So if you're, for example, really strong in the auto world, you may have paid off 5 leases, never missed a beat. You'll have a really high score that day on your auto report that they pull because of that history. You might have missed a payment on your mortgage. It doesn't play as much of a factor in that score. Whereas if you go to the mortgage office that day, you have 5 paid auto leases, but you had 1 mortgage late, you're going to see a really heavy hit to your mortgage score, because that filter or that algorithm they're using on the report is going to look more closely at your mortgage history. Do you see what I mean?
Yeah. Had a couple questions about opt-out pre-screen. If you have good credit, is it still a good idea to use opt-out pre-screen, or is it just for those with bad credit?
No, that's a great question. Here's what you're going to lose if you opt out and you have perfect credit. A lot of those offers you get in the mail that say transfer your balance 0%, those 0% transfers where you get a sort of 6-month or a year-long interest rate deferment where they take and not charge you any interest on any balances you transfer over, unless you go beyond that waiting period. So a lot of people don't know there's fine print on that. So if you're liking those offers, then stay opted in because you're going to keep getting them. You're also going to know another thing they'll do is this will take away, and this is another detriment if you have good credit, is you know how sometimes your credit line will increase just on its own because you're paying your bills on time, and well, that's because creditors are seeing all that other good history you have and they're increasing your limits. So if you opt out and you have good credit, you're going to take away those 0% offers you get in the mail, a lot of those insurance offers, and you won't see your credit line just increasing incrementally every 6 months to a year like they do.
Are you aware of any government programs related to COVID that could assist clients that have COVID related debt or charge-offs?
That's a great question. I don't know of any specific programs, but I'll look into that. If your guest wants to email me, I'll definitely have some answers by the time I respond back. I do know that for your guests, anybody that's been hit hard by COVID and is fallen behind or they're struggling, call your creditors up, because I've done this myself too, just to see if it worked, and tell them that, hey, I'm struggling due to COVID. I hear there's some relief that you offer. And creditors will just almost with a phone call, just give you a 3-month hiatus on your payments. So they just basically they add 3 months to your end of your loan contract, but they don't require those 3 months to be paid on month 4. So you're just going to pick up on month 4 where you left off
Yep.
4 months ago. So if your payment's on a car loan, $300, they'll give you a 3-month, 2 to 3 month break with just a simple phone call. And then you just don't make a payment for those months. And I had all my employees when the pandemic hit, they were trying everything they could to save their credit. And that was one of the things they found worked really well. And all their creditors within a matter of an hour just immediately held their payments for 3 months and didn't charge them an additional fee, didn't hit them with one big lump sum payment or none of that. It was just basically deferment.
Awesome.
Liz, we do have 2 giveaways. Do you want to
We
drop
do.
your names on your,
So now we have 2 giveaways. So here's what we're going to do. Everybody that's interested in the giveaway, type Civic in the chat right now, and we will collect all the names. Oh my goodness.
It can be
Yeah,
for
As you heard that.
They're 2
Type Civic in the
$1,500
chat,
values, right?
and we will
1,500.
choose
Yeah,
a winner.
1,500. Yep. It can be
Or
for
2
a friend or
winners from each.
family if the person that wants to put their name in the hat doesn't have bad credit, but they may want to gift it to a client of theirs or to a friend or family too, whoever ends up winning them. Just make sure that when they do call in here that they mention they found us through the podcast.
What we'll do, Steve, is Liz is going to have the 2 names. We'll give you
give us the names.
company those 2 names, and then we will for our end, for our one, we will send a check your way. Then you'll obviously take care of yours.
Yeah, we will pick 2 names, but if you are interested in reaching out to Steve, his information is hopefully on the screen. It's info@americancredit.com. It'll go to his team. They'll handle it. And if you have your credit report, the consultation is free. Otherwise, they do have to run a credit report for $35. And there's no obligation to enroll. They'll give you recommendation and just save 20% off the top by mentioning Civic. All right. Well, we thank you, Steve, for being with us today. This was a great program. I will try to organize all of the questions, but again, a lot of them were individual scenarios, and I'm actually curious about a lot of the answers to their situations. But you guys can email Steve direct at info@americancredit.com. And thank you so much for joining today. We will be sending up a follow-up email to all of the attendees with a copy of the video and the Q&A. So thank you, everybody. Have a great day.
Thank you, Steve.
Bye. Thank you.